I'm Ron DeLegge. It's great to see all of you. Financial markets have been on the mend since bottoming in April. So which assets and which ETFs are outperforming, and will it last? Well, let's find out some clues and some answers. And I've got some charts I want to share with you. First, I want to start with a poll that was taken at the community tab on this channel. And I asked, gold versus Bitcoin, which is the safer bet during market turmoil? An overwhelming percentage of those who answered this question felt that it's gold. Gold is the better place to be during market turmoil. And gotta say, at least the performance of gold during this particular turbulence, I'm not going to say the word, it begins with a T, but rhymes with sheriff. Not going to say it. You fooled me way too many times. You tricked me into saying that word. I'm not going to say it. Starts with a T, rhymes with sheriff. Since that time that we've had lots of sheriffs, gold has done much better than gold or Bitcoin during all that volatility. It was gold that was the better play, at least during this last period of volatility. But nevertheless, we're going to take a look at the performance of each on this next chart: gold versus Bitcoin versus stocks versus bonds versus real estate versus broader commodities. This is your big picture view of the ETF marketplace. And really, when you think about it, this is what I would call the core asset classes. With the exception of gold and Bitcoin, I don't really consider them as individual assets. I wouldn't consider them necessarily core holdings. They can be supplementary to core. Core to me, when you're talking about portfolio construction, is really you're looking for broad coverage to a specific asset class that gives you diversified exposure to that asset class. You're not trying to outperform that asset class. You just want exposure to it. You want to replicate it. And so something like SPY, which tracks U.S. stocks, large cap, that would be an example of what I would call a core asset class or core holding. You'll notice that, by the way, I mentioned SPY as the first one. It's the only asset or ETF on this chart that is negative, and it's got a 3.5% loss. Well, I shouldn't say loss. I should say decline. It's a decline. It's not a loss. It's not a loss until it's realized, right? So it's got about a 3.5% decline compared to all of these other areas, these other ETFs. And it's interesting that, like I said, since April, it's made a nice little bounce here. And we're going to see if it can cross into positive territory and maybe even record some positive upside. We'll see. Some of these other assets we talked about, gold being a great performer. It's the best performer on this chart, up over 26% since the start of the year. And GLD has been a great performer. We're going to take a look at an area of the gold market that's been even better performing than physical gold. More on that in a second. And then look at Bitcoin. Bitcoin has also made a nice comeback. It's up about 10.5%, IBIT. And I don't know if you see this. I'm no expert when it comes to charts, but I see, at least on the Bitcoin chart, IBIT, it's in that hot pink. What a perfect color for crypto and Bitcoin ETFs. Hot pink. I see an inverse middle finger chart pattern. I'm not sure if you see that, but take a closer look. That's what I see, and I have no idea what it's telling me. It's crypto. It's always a pavilion of pandemonium and a tabernacle of confusion and a cathedral of turmoil. So that's how the crypto market works. But so far, Bitcoin ETF investors, if they've been holding, are pretty happy. At least they should be. Now, in terms of S&P 500 industry sector performance, we got 7 up, 4 down. Now, if we go back a month, you'll see that the vast majority of sectors were actually down. We had just this particular table, the same table, and we actually only had three industry groups or ETFs that were up within the S&P 500 sector-wise, and the rest were down. 7 were down. So now we got more sectors up than down. We see a swing in momentum to the upside. And look at the downside performers. Really, these, I would say, are relatively modest losses. These aren't the type of deeply bearish losses, not just yet, that we're seeing in these sectors. So modest losses is what I would characterize these at. And all of these ETFs that are, even the ones that are negative, they are in recovery mode, and they have been building some upside momentum. So that's a good thing for equity investors. Now, in terms of, and I forgot to mention this earlier, I want to direct you to our playlist. We added a brand new playlist on this channel dedicated to ETFs and retirement planning. I want you to understand that ETFs are wonderful tools for building a retirement portfolio, specifically if you've got a 401k plan. If you have your own plan, a 401k or a workplace 401k, maybe you got a small company that you're running, or perhaps you work at a small company and you're in touch with the owner, tell them about ETFK Retire, because we've got the best ETFs on the investment menu. We've also got buffered ETFs, as well as a whole mess of other wonderful choices. But it's an all ETF 401k plan. There's no mutual funds. There's no other investments. It's strictly ETFs, low-cost ETFs. So go to ETFK.com. We've got this playlist that we just added, which is dedicated, and I keep dropping new episodes, myself and some of the team behind ETFK. We're dropping new episodes to educate you and help you understand the benefits of ETFs and 401k plans. So do watch some of that content, digest it, and again, go to ETFK.com if you want to add ETFs to your 401k plan, or you want to convert. You want to completely migrate your existing 401k plan away from legacy mutual funds to something better. Upgrade your 401k. Again, you could do that at ETFK.com. Now, in terms of this particular chart that I really wanted to share with you, we talked earlier about gold being a great performer. Well, what about gold miners? Does anybody talk about them? I don't think they've been getting enough attention, and this chart shows that gold miners are outperforming physical gold by a huge margin. The unleveraged ETF GDX, which tracks gold mining stocks, up almost 50% since the start of the year. It's about double the performance of physical gold. And look at those mining ETFs, gold mining ETFs that are using leverage, 2x, bullish daily leverage. These are direction ETFs, and we've talked about them before on the channel. They have got some major upside momentum, and both are up over 100%. Nugget, NUGT, and JNUG, JNUG. So check out those ETFs. If you're bullish on gold, I don't see why you wouldn't be bullish on gold miners. Now, here's another ETF that I need to mention that gets almost no recognition. It's underappreciated, underrecognized, and it deserves more attention. Ticker symbol USG. This is an ETF that has exposure to gold, but then it offers income potential on those gold holdings. And that's one of the things a lot of investors don't understand about gold, or maybe they forget, is that gold has no revenue. It's not like a company. It doesn't pay any income. And so it doesn't pay any interest or dividends. And so when you buy gold, it's a directional trade. You're hoping that capital appreciation arrives at some point in the future. But while you wait for that capital appreciation to happen, why not receive some income? Why not receive some money in your pocket? And that's what USG does. It uses a covered call option on physical gold, and it carries a 30-day SEC yield of almost about 3.5%, this is as of the end of April. But again, this is a great ETF that I think more investors should be looking at. You get that exposure to gold, but then, there's always the possibility that gold doesn't necessarily give you that upside performance. And so, again, this gives you that income while you wait for your gold to go up, or maybe you want to have more of a income-oriented portfolio. That would be a good potential solution, USG. Now, you want to know how that USG compares to, let's say, GLDM, one of the biggest physical gold ETFs. I thought you'd never ask. And so I put together a chart comparing the two over the past year, and you can see that USG has done a good job of keeping up with physical gold, straight gold, GLDM, which has exposure to gold bullion, and it does not use GLDM any sort of income strategy. It's just straight exposure to physical gold bullion. Whatever that price performance is, GLDM aims to replicate. But USG, again, has that similar approach, wants to give you exposure, is giving you exposure to physical gold, but then adds that income potential on top of it. And look at the numbers over the past year. USG's done a great job of replicating and closely being linked to the price of gold bullion while giving you that income on top of that performance. So check out USG. Like I said, one of those nice ETF ticker symbols that doesn't get a lot of recognition, and it should. In terms of other assets that I want to bring to your attention, copper and uranium. These are both ETFs that have been interestingly performing pretty decently. Uranium just more recently has really made a run after being down over 25% earlier this year. It has made a massive run to the upside, and now it's just at about break even. If we look at the 2025 year-to-date performance, URNM, and lest I remind you that some of the biggest companies on this planet, the Mag 7 companies, Amazon, Microsoft, they are very much in the business of powering their AI data centers. And where do you think they're setting up these AI data centers? They're setting them up close to nuclear power centers. And these power centers are fueled by uranium. They need uranium and they like that nuclear because it's always online, it's stable, it's not intermittent like solar or wind power. And so uranium is definitely a play on that nuclear energy renaissance, which is currently unfolding. Copper is also part of that story because copper isn't just an AI story, as these data centers have a need for copper, but also you've got the whole revolution of EVs, which is stalled a little bit, but it's still there and it's not going to go away. And so copper, CPER, is a physical copper ETF that you need to put on your radar, and it's held up pretty well. It's been volatile, but it's still nevertheless up double digits. Put these two ETFs on your radar. Now, what is the big money doing? Well, we take a look at the Bloomberg Billionaires Index. These are the top billionaires in the world. And I highlight technology because that's where their wealth is concentrated. That's where they made their fortunes. And I think from an investment perspective, I need to keep reminding you of this, that from an investment perspective, I think orientating the investment portfolio more towards technology, more towards what's coming in the future, what's unfolding right now, things that are in the process of developing, these investment themes like AI, like digital currencies, cryptos, all that. This is all, if you want to group it into one area, you can house it under technology, right? And so this is how the big money became big. And this is, I think, a lesson for all of us as far as from an investment perspective, orientating that money. So in terms of investment portfolio construction, you got three cornerstones that are the foundation of your portfolio. You've got your core, your non-core, and your margin of safety. Something I want to remind you before we close today's episode about the margin of safety is that it is not market timing. It is different from your emergency fund, and it is a permanent cushion within your overall investment portfolio. So let me explain this with a few illustrations. Look at your house. The insurance protection on your house is not determined by the weather or the outside elements. It's determined by how much you want to protect your house, right? You could be underinsured, you could be properly insured, or you could be without insurance, right? Now, the prudent person is properly insured. It's the same way with your investment portfolio. You should be properly insured. You should never be underinsured or completely without insurance. But you'll notice that the house, its coverage is not being determined by the weather of the day. It's not being determined by whether it's sunny outside or rainy outside or partly cloudy or lots of clouds. The house, its coverage is being determined by how much needs to be protected. And so it's the same with your portfolio. Portfolio, your margin of safety is not determined by external market conditions. It's not determined by whether the market is happy or the market is sad or whether volatility is through the roof or whether volatility is through the basement. It's not affected by any of that. And that's why, to my point, your margin of safety is not market timing. It's completely different. The only place you do market timing within the context of your overall investment portfolio is within the non-core portion. That's number 3 on this chart or visualization. The non-core portfolio, you could be and use market timing. That's fine, but your margin of safety is not impacted or affected by external market conditions. It shouldn't be changing day to day like market timing. Market timing can change day to day, and it should, right? Because that's what you're trying to do. You're trying to take advantage of certain anomalies that might occur in the market, but margin of safety is not doing that. It has a completely different function than market timing or the stuff that happens in your non-core portfolio. So that's very important to keep in mind. And then it's also different than your emergency fund. Your emergency fund is strictly geared for, generally speaking, 3 to 6 months of expenses is what you should have set aside to cover you in case something comes up. And so that's important for me to educate you on. Be sure to watch some of our upcoming episodes. We've got new episodes of ETFK Retire. We've also got First Look ETF, a new episode coming. And then John Love with USCF Investments will be joining us. He will be talking to us about what's going on in the commodity ETF space, and specifically USG, which is the ETF we mentioned in this episode. He's going to dive into that particular ETF, along with copper, which has been a strong performer this year, so be sure to check that out. Those of you new to our channel, be sure to hit that subscribe button. Hit the comment section below. Let me know how you've been enjoying our content. And, of course, besides YouTube, you can watch us in all these other places, Roku, Amazon Fire TV, as well as Apple TV. Well, that does it for today's episode. It's been great being with you. I'm Ron DeLegge with ETF Guide. We'll see you on the next episode.